Today, we're going to analyze the top 5 stocks that investors in our Everything Money community are buying. Stock number 1, Atkr, Atkore. We've talked about the stock before. They do electrical nodes and devices and little things, but look at this. Here's the interesting part. And this is what I love about our community. All-time high, 195 back in April. Now, on September 11th, 2024, never forget, it hit a low of $80 per share, and it's currently at $84. So it's up 5% from its low back in September. This is a company that's been beaten up from a share price perspective. But remember, we want to find companies that even though the share prices are down, the fundamentals are getting better. So some high-level metrics. $3.2 billion market cap, 4.3 enterprise value. That difference there is essentially the net debt. So about $1 billion in debt, but here's the good news. Their free cash flow, $400 million last year, $450 million the last 5-year average. It's lower than their net income. So first question is, why is that? But here's what's getting everybody's attention. PE of 5.8, price of free cash flow of 8. This is what's getting everybody's attention. A small piddly dividend of 0.36%. My question is why? Funny thing is, even though their net income's down, profit margin is down significantly. So that tells me revenue is down. Let's go check that out. Yep, revenue is declining. 1.5, 1.5, 1.8, 1.9, 1.77, 2.9, 3.9. Last year, 3.5. Last 12 months, 3.3. So revenue is dropping. The first question you have to ask, for those in our community, the first question you guys got to discuss is go do the research on, is this a decline that's on its way to get worse? Or is this understandable because of this big jump during COVID? Remember, you don't want to buy a company based on its best years if the best years are behind them. You want to buy a company based on what they're going to do during a normal cycle. And the question to ask yourself about Atkore is this a normal cycle? And the stock has fallen so much, so quickly, even if it's not the normal cycle, hasn't been beaten up enough. That could be the case. So let's see what analysts are saying about that. Go to our analyst estimates on our software. Not much there, but a 23% drop this year on EPS, another 15% drop expected for next year, but rebounding according to the 6 analysts who are following it in 2026. Revenue, 10% drop this year, 1% drop next year, 5% growth. So it's something you definitely need to spend more time looking at. Now, remember, every investment is the present value of all future cash flows. That's why we use Stock Analyzer tool. The Stock Analyzer tool allows us to make assumptions about the future, and it tells us based on those assumptions what the right price to pay is today, not including the balance sheet, okay? So for Atkore, let's go use a Stock Analyzer. I did a 10-year analysis. Now, one thing I do like about this, high return on invested capital. So this company does a great job of managing the money invested in the business and using it to generate more profit. I did 2%, 4%, and 6% revenue growth. What I think we need to do, though, is -2%, 1%, and 4% revenue growth. So guys, this is what's so great about Stock Analyzer tool. You can do the low, middle, and high to put in a wide range of assumptions. And if it hits your greens, you do more research to see which one's more likely. Profit margin, I did 10%, 14%, and 18%. Same with free cash flow. And for PE, guys, unless the company is permanently declining, it has a high ROIC. I don't think 5 and 8 times earnings and free cash flow is reasonable. I did 12, 15, and 18. And finally, what is my desired return? I did 9%. Now, do I think a company should get 9% return? No. If you want a 9, 10% return, invest in a low-cost ETF. But this allows me to say, what's the intrinsic value? You need to add your margin of safety in there by increasing that desired return, okay? What's that right number? I don't know what it is for you. So let's hit the analyze button. Guys, it's actually exactly on the nose. 86.37, 86.37 on the nose. Have we ever seen that happen? I don't think we have. That's incredible. Exactly on the nose. If this goes up 1 penny, it's going to be red. Middle of 166, a high of 297. My opinion is, take a look deeper into this. Based on today's price, and by the way, you saw it just change right here. 9%, 20% returns in the middle, 30% in the high if you bought it at today's price. Assuming your assumptions here are correct. That's the big part. So this one tells me, go take a deeper look. It's worth the work to go put in there to make 20 or 30% a year. Stock number 2, one of my favorite stocks out there, one that I do not own, but one that I can't wait to own, the Googly Moogly. It's twice its low from just a few years ago. All-time high of 193 back in July 10th, only 3 months ago. 52-week low of 121 back in October of last year, just a year ago. Shows you how much things can change. Guys, great balance sheet. $2.1 trillion market cap. Essentially the same thing for enterprise value. Very little debt in the company. Look at this free cash flow. Now here's the interesting part. Free cash flow of $61 billion, net income of $88 billion. Big difference there. 5-year average free cash flow, net income are much closer. $57 billion and $63 billion. Now, this is a lot of money. And it's harder to get really good deals on large companies. But the important part about Google is to sit there and say, this company, the story behind it is incredible. They own the 2 largest search engines in the world, Google.com and YouTube.com. This company owns this is an advertising business. They own the advertising space. But the story has to match the numbers. And that's what's really important. If you only follow the story, you're probably going to end up overpaying at some point. But if you mix the story and the numbers together, that's what's going to make you a great investor. Okay? So let's look at the 8 pillars for Google. Guys, 6 checks, 2 X's, and the 2 X's are valuation. But remember, we don't know if the valuation is too high. Google is a premium company that deserves a premium valuation. How premium? That's the hard part. So let's see what analysts are saying, and I'll show you this. Look at this earnings per share growth for Google. 33%, 14%, 15%, 14%, 22%. This earnings per share is growing so much, you gotta pay a premium for that. Absolutely have to. You'd be doing Google a disservice and yourself a disservice by paying 15 times free cash flow for this company. Okay? Revenue growth, big time also. High single digits, low double digit revenue growth. Again, same thing. So, stock analyzer tool, and I am only doing a 1 assumption here because it's a pretty large company, so I'm okay just starting here. 7.5% revenue growth. Now you saw on the 5-year revenue growth, it was higher than that. So I'm probably being too conservative here. Let's call it 9%. Let's do the profit margin at 24. Same with the free cash flow. And I put my PE and price of free cash flow of 23. That's the premium I'm paying. A big premium to the market. Hit the analyze button. I have the stock currently worth 201. At current price today, 11.5% return, assuming everything above is correct. Because their balance sheet is great, so I don't have to worry about the balance sheet here. So, based on today's price, again, I think it's something to take a look at. I think our users of our software are doing a great job of sitting there and finding a potential opportunity there. Stock number 3, one that's been surging lately, Alibaba. Alibaba, if you look right here, last 6 months, up 54%. 40% in the last 3 months, year to date 45%, 1 year 30%. Now, this is a company I've owned for a while, and I think I'm a little bit still in the loss for it, but that doesn't bother me. Why? Because I look at Alibaba and say, what's the future of China? Now, a lot of people say, oh, there's a war, there's gonna be a war with Thailand. Yeah, maybe there will be a war. But I look at it, what's 20 years from now? And that's a hard thing for investors to do. It's not hard for me, but I can sit there and say, where is Alibaba going to be in 20 years? Now, I don't know the future, but if I'm betting on China, will China be a bigger country economically in 10 or 20 years from now? Yes, I do. And if Alibaba is around, will they do very well if that happens? Yes, they will. So I look at that saying, okay, let's take a look at this company because it is 320 is its all-time high. It was a low of $66 back in January of this year. The previous low, I think, was $58 that we saw a couple of years ago. Back here in $58.01 in October of 2022, 2 years ago. $58. It's up almost 100% in that time. Remember, paying more hurts you versus paying less as long as fundamentals are getting better. That's the big key. So let's go look at the cash flow fundamentals on this company. That's what's interesting, guys. 13, 14, 19, 27, 12.5, 23, 21, 19.5 in the last 12 months. So there's a decline in the last few years, but it's still a very high free cash flow business. It is currently selling for 13 times free cash flow after going up 100% almost in 2 years, after up 45% year to date, after up 30% in the last 1 year. It's still selling for 13 times free cash flow. Let's see what analysts are saying about EPS. Not much growth here, according to analysts. I have a hard time believing this, but maybe they're right. There's a lot more analysts here following the company, and there's a lot of uncertainty in China. but that uncertainty is what led to a lower stock price. That's what the benefit of uncertainty is. That's what the benefit of fear is as an investor. Sitting there and saying, okay, what's that going to do? Because look at the EPS, look at the revenue growth here. 8, 7, 8, 7, 7, 3. Man, I have a hard time believing if they grow the revenue like that, the profit's going to be basically the same. But these are the same analysts who are doing this. And I talk about this all the time. I like looking at what the analysts are doing, but you have to sit there and understand it as a company. Now, as you guys know, when stocks fall, if you're alone at home, investing is that lonely journey. Watching a stock fall, saying, what is going on here? It is very crucial to surround yourself with a supportive community of like-minded individuals to limit the emotional pitfalls of investing. Because remember, investing isn't about the numbers. It's 90% about the stomach and the emotions. And that's what makes the Everything Money community so incredible. Everyone is dedicated to achieving financial success together, and everyone has realized it's more about the emotion than the numbers. Now, I remember when I first built this software for my own journey, I did not expect to see how many people would be interested. I built it for myself. And when I was using it on the channel, people would say, hey, how do I get access to that? And I'd say, listen, you can't do it. It's an expensive data feed. You're not going to be able to do it. But then it hit us. There's demand for the software. We kept hearing it over and over. How do I get this? So we said, okay, this is realizing how important it is for us to serve the community better. So we made the software. And we're currently working on some changes. But the good news is these changes aren't live. Right now, the software includes all these tools for stock, real estate, and retirement. And if you join now, you'll be grandfathered in for life to get these features that we've created and keeping them in the pricing tier that you're locked into. But these changes are going to happen, and we're going to start splitting these things off and having to buy them separately. So if you're committed to making smarter financial choices, and more importantly, reducing the emotional stress in your life, click on the link in the description below to secure access before these changes happen. And just a reminder, we have a limited number of daily spots available for our software and community. So click on the link and sign up before it goes away. It's only $7 for 7 days to try it out. It's a no-brainer. So go ahead and do that. So let's do the stock analyzer tool for Alibaba. I did 10-year of I did 3, 6, and 9% revenue growth. I did profit margin of 12, 15, and 18%. I did a higher free cash flow, 15, 18, and 21, because as you see, free cash flow is consistently higher than earnings, which we love. Now remember, a lot of people, I've worried about fraud in China a lot. But if there was fraud, this is what they'd be lying about. Unless they're the ultimate fraudster, which could be the case, and they're lying about the free cash flow to throw people off. But everybody follows profit margin, not free cash flow margin. So why would they show a higher free cash flow than profit margin? Okay. PE, currently 27, and price of free cash flow of 13. I put 16, 18, and 20. And again, my 9%, no margin of safety return. Hit the analyze button. Guys, I got a low price of 105 to 130, high price of 285 to 330, middle price of 175 to 210. That's why I'm not worried about my cost basis right now. I'm very excited about Alibaba, but remember, don't buy a company just because I or anybody else on the internet has it. What's important is for you to do your own research and find a company that fits your thought process. Stock number 4, Nike. Guys, great brand. Great company, going through a lot of public problems right now, have a new CEO starting today. All-time high of 179 back in November of 21. 3 years ago now, and it's currently at 81 bucks. And trust me, go back and look at videos of us on Nike. I guarantee people were saying, that stock would never fall below 100, blah, 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 blah. We've heard it before, we'll hear it again. It hit a low of $70 a share back on August 5th, a mere 2.5 months ago. That's what's incredible. Guys, great company, great brand. They own the basketball world. Look at their 8 pillars. Check marks all the way around except for valuation. But this is a premium company. As much as the news is negative about Nike, I have a question of what really is negative about Nike? There are allegations of having children working in factories. That's been going on for decades. People have been saying that. I look at this saying, this is a great brand. They have Kevin Durant, LeBron James, and Michael Jordan on lifetime contracts. They're doing a great job making great shoes with immense demand. Okay. I'm looking at this, and I'm looking at let's look at their analyst estimates. Let's look at revenue first. Not some big revenue growth, it's such a big company, but 52 billion to 66 billion in the next 5 years. That's some big time growth for a company this size. Earnings per share growth, almost doubling in the next 5 years. So everybody's talking about Nike. I've literally heard people say Nike is dead. that's when you want to be looking at a company. I look at Nike and say, this might be a great example of a stock price that's down a lot while the fundamentals continue to get better. So let's go to Stock Analyzer tool. Guys, I didn't do major assumptions. 3, 5, and 7% revenue growth. 10, 11, 12 on free cash flow and profit margin. 20, 23, and 26 for my multiples. Why? Premium company. I don't care what anybody says, it's a premium company with a high teens and 20% ROIC. This means moat. This means good allocator of capital. And my 9% market return, hit the analyze button. I have a low price of 60, high price of 119, middle price of 85. For me, I have it on my watch list below 80, not to buy it below 80, but to sell puts at lower prices. I'm excited about Nike, and I hope it falls to 40. I repeat, I hope it falls to 40. And hopefully if there's a big stock sell-off and this bear market of 874 years finally ends, we'll be able to buy Nike at even better prices than today. Stock number 5, the final company, Celsius. Celsius is the healthy energy drink. It has, if you saw right here, it's skyrocketed. It's still up 3,000% in the last 5 years after being down 55% in the last 6 months. That's incredible. This company has absolutely killed it. Absolutely killed it. Great balance sheet. $7.8 billion market cap, $7.4 billion enterprise value. Look at that. Great balance sheet here. Great balance sheet here. Return on invested capital last year, 15%. Still, even though it's down so much, it's still selling for 31 times free cash flow and 26 times earnings. So, okay, it's a little bit, needs some work here. But of course, it gets everybody's attention because all-time high of $100 was just back in March 14th, Pi Day. March 14th, which was 7 months ago. 52-week low last week of $28. That's a fall of 72% down and still selling for 30 times, which means it was selling for 100 times free cash flow. It's attractive because it was a very exciting company going up and then it was exciting going down. Look at that down. You're telling me that the company changed its fundamentals 70% in the last 7 months. I doubt that because look at this. Look at their revenue. In the last 12 months, $1.5 billion in revenue. Previous years, 1.3, 650, 340. They basically doubled their revenue every year for like, I don't know, a long time. That's incredible. Now, is that going to continue on? It's not possible. It's not possible to double your revenue forever. Let's look at the 8 pillars here. Interesting. 4 checks, 4 X's. 5-year PE, 5-year price of free cash flow. Guess what I'm doing with these? Not even paying attention to them. Why? Massive growth company. 5 years ago, they did $14 in revenue. Not literally, but I'm being funny about that. You cannot look at their 5 years of free cash flow and 5 years of earnings and say, oh, that's reasonable. It's a massively growing company that's grown a ton in the last 5 years. 5 years ago, the revenue was $75 million. It's 20x from today. It is, you'd be hurting yourself by looking at the 5-year PE. So I don't even look at these things. Return on invested capital, growing business, probably skewed low. I like the fact that this year's return on invested capital in the last 12 months is 15%. Shares outstanding are higher. I don't like that so much. Fast growing business. They use the excitement of the stock. I don't blame them. Get those shares out, get the cash in your balance sheet, make it better. I just don't want them in the habit of doing that. That's the issue here. So let's see what analysts are saying about the company. EPS, $1 a share going to $2.74. Great growth in EPS. And revenue doubling from here for the next 4 years. That's 20% a year. So guys, what's the story about Celsius? Well, it's a great option for an energy drink. I will say this though. This is a very, very crowded space. You've got to have a little bit more margin of safety in this one, in my opinion. That's what I'm doing. I would have a little bit more margin of safety because I look at it saying, these companies come in, come out, go in, go out. I will say this, as the stock price falls, start watching for somebody to acquire them. Now, back on August 1st of 2022, it was announced that Pepsi made a $550 million investment in Celsius. Okay. Now, terms of that deal are out there on the internet, but as you can tell, Pepsi wants in on the Celsius bandwagon. They see this and say, let's add this to our portfolio to compete more with Coke. So let's go look at Monster beverage to see how this company could compare to that. Monster last year did revenue of $7.4 billion, 5 times larger than Celsius. The great news is about Celsius, great balance sheet. Same with Monster, great balance sheet, essentially no debt on hand, which I love seeing. But Monster's a lot bigger than Celsius, so it shows the potential growth potential for Celsius as time goes on. So what is Celsius worth to us? Let's go look that up right now based on the stock analyzer tool. Now, wide range for the next 10 years. I did 6, 12, and 18%. I'll be honest with you, I don't even know how much I like these. I'm actually gonna go a little bit lower. I'm gonna go 4, 8, and 12%. Now you might be sitting there saying, Paul, that's so freaking low. Maybe it is. That's why if you have our software, you can put it in yourself and come up with your own numbers. 15, 20, and 25% for profit margin and free cash flow. I did a PE of 15, 20, and 25. Again, this is at the end of 10 years. That might be on the high side. And I did my 9% return. So there's a lot of numbers here to analyze. I have a low price of 15, high price of 67, middle price of 33. So for me right now, it's not obvious enough for it's like, I got to go take a look. So if you guys want to see a video on the 18 stocks that I own, watch this next video. Thank you for your time.